We're living through a massive financial shift right now. The simple act of raising interest rates has kicked off this incredible chain reaction, and it's quietly reshaping pretty much everything, from your credit card bill all the way to the future of Bitcoin. So let's break down the macro mechanics of what is really going on. That one sentence just captures it all, doesn't it? It's this huge ripple effect. When the fundamental cost of money goes up, it doesn't stay put in one corner of the economy. No, it touches everything. So let's follow those ripples. To really understand this whole shift, we have to start at the very beginning, with the single most powerful lever in the entire financial world, the price of money itself. That's it. It sounds so simple, right? At its very core, an interest rate is just the price you pay to use someone else's money for a while. But when that price changes, the behavior of everyone, from you and me to entire countries, changes right along with it. Think about it. For more than a decade, we all got really used to cheap money. It was almost free to borrow. Well, that era is over. We've gone from basically 0% rates to a long, sustained period of high rates. And that's not just a little adjustment, it's a whole new ballgame, a complete paradigm shift. So you might be asking, why on earth are policymakers doing this? Well, the short answer is they're trying to hit the brakes on the economy. By making money more expensive, they're trying to discourage borrowing and cool down risky investments. This isn't just about fighting inflation. It's about fundamentally rewiring financial behavior, from Wall Street all the way down to your local Main Street. So where does that first ripple actually hit? Well, it lands squarely in the world of credit. This is the place where that abstract idea of interest rates becomes very real, very fast. It's really like a domino effect. As soon as central banks raise rates, the lenders, the banks, they start to get nervous. It's not just that they charge more for loans. They get a lot pickier about who they even lend to in the first place. All of a sudden, getting credit isn't just more expensive, it's a whole lot harder to get. And this is where it hits home for so many of us. That credit card balance you've been carrying, suddenly the interest is piling up way faster. That dream of buying a house, it gets a lot tougher when mortgage payments shoot through the roof. And for small businesses trying to grow, getting a loan turns into a really selective, difficult process. This is how the economy starts to change, long before you hear about a recession on the news. But, the pressure doesn't just stop with credit. It starts to spill over into places most of us don't immediately think about when we hear interest rates, like the insurance industry. Okay, this is where it gets really interesting. For insurance companies, high rates are kind of a double-edged sword. On one hand, hey, they're making more money on the massive piles of cash they invest. But on the other hand, they're insuring a world that's becoming riskier and more expensive. So this forces them to ask a really tough question. What is the true cost of insuring our future now? So what's the bottom line? Well, while the insurance companies might be making more on their investments, they're also staring down the barrel of bigger potential payouts down the road. And the result for us? Higher premiums. It's a bit of a delayed reaction, but believe me, it is a powerful one. And what's so important to understand here is that the insurance industry isn't reacting to the day-to-day drama at the stock market. This is a very calculated, long-term response to a fundamental change in financial conditions. It's a measure of deep systemic risk in the whole system. So, we've seen these ripples move through credit and insurance, two absolute pillars of traditional finance. But now, that wave is reaching a completely different coastline, the digital shores. So the big question is, how does all of this old-school traditional financial pressure, impact something as new and different as digital currency? And this is where Bitcoin quietly enters the picture. For years, Bitcoin was kind of seen as its own separate universe, right? Totally disconnected from the old financial world. But as you can see, that's just not the case anymore. In this new era of expensive money, Bitcoin is actually starting to move more and more in sync with traditional markets. The days of it being just a wild, speculative asset are definitely fading. So what does that actually mean in practice? Well, with less easy money just sloshing around the system, there's a lot less fuel for pure, wild speculation. Instead, we're seeing the big institutional players who are way more cautious come into the market. And that's why Bitcoin now reacts to things like Fed announcements and economic data reports. It's growing up. It's becoming part of the mainstream financial world. So this brings us all the way back to the people pulling the levers in the first place, the policymakers at the central banks. What are they actually looking for when they create this kind of high-rate pressure cooker? These policymakers are basically walking a very, very thin tightrope. They're not just trying to bring inflation down, they're trying to do it without accidentally breaking the entire financial system. So they're constantly looking for cracks in the foundation, in the credit markets, in the insurance sector, and just in the overall mood of the market. And that, right there, is the ultimate mission. In a high-rate world, the number one goal shifts away from just promoting growth at all costs. The new goal is making sure the system itself doesn't break. It's all about preventing those ripples we've been talking about from turning into a destructive tidal wave. So, as we wrap this up, I'll just leave you with this question to think about. From where you're sitting, in your own life, or just in what you see happening in the world, where are these high rates hitting the hardest right now? Is it the squeeze on credit, the rising cost of insurance, or just the simple, direct pressure of the rates themselves?